This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So we have another chapter here that advances your knowledge from the glory days of financial accounting. But don't get too stressed about it and think, oh no, I've forgotten everything from the days of financial accounting. Like with the other standards that we've seen, inventory, PPE, you know how quickly it comes back to you. And like those standards as well, we just extend the difficulty of it that little bit further. Okay, so we look at more than what you would have previously seen, I believe, in your financial accounting paper. Okay, and what we're accounting for here is provisions, contingent assets, and contingent liabilities. Okay, and effectively it's all about accounting for uncertainty. So we're going to look at it from the liability perspective first, because the contingent asset perspective is just tiny and not even worth putting anything on screen, but we'll consider that later on. So we're going to look at it from the liability side, and we're going to go back to the framework and look at the definition of a liability, look at the recognition criteria and how that can then go through there and link into a provision. Because businesses will have outstanding possible liabilities at the end of a reporting period. Now, what we need to be able to do is we need to determine whether or not we should record that liability at the end of the year, or whether or not there is not as significant a likelihood of that liability arising, and therefore disclose the potential for that liability. So disclosing the actual liability itself with regards to what it relates to and the financial effect of it. So, like I said, let's go back to the definitions within the framework. So the definition of a liability is an outflow of economic benefit that results from a past event. Okay. However, what we've got to think about there is the recognition criteria as well, and that we will recognize that liability, that outflow of economic benefit as a result of a past event if we can go through there and measure that outflow reliably, and if that outflow is probable. Okay, so what we're going to do is we're going to bring that into the specifics that are dealt with under IAS 37 to help us look at a provision. So common scenarios of where provisions may be relevant might be there with regards to a legal case. So you are being sued by somebody for some wrongdoing. At the end of the year, should you make a provision for the fact that you may or may not lose that court case? Businesses that sell electrical goods will offer warranties with those electrical goods. So that means, therefore, that those goods might come back and need some form of repair. Okay, so the issue that you've got there is, do we provide for the level of repairs that we know will happen in the future? Okay, so what we've got to do is we've got to make sure that we have a specific set of rules in order to be able to account for the provision. So the accounting will be to debit the statement of profit or loss and credit your provision. But we need to go through there and ensure that we meet the definitions within the framework. So what we've got there is that you need to have a present obligation. So that obligation will either be a legal obligation or a constructive obligation. I think a legal obligation is pretty self-explanatory. There is something written into law and you have broken that law. Okay, or you have gone through there and potentially broken that law. Okay, there is an obligation, a legal obligation to maybe clean up some environmental damage. Okay, what about a constructive obligation? A constructive obligation is whereby there is something that maybe you may have communicated to an external party, or there is a demonstrable pattern of past practice, because that then creates that obligation in the mind of the person who has entered into the transaction with you. So if you've gone through there and said that you will go through and rectify any environmental damage within your website or within your annual report, even though there is no legal obligation to do so, then therefore there will be a constructive obligation because you have created that obligation. There is an expectation that you will deliver on your promise. Similarly, some businesses will go through there and offer refunds on goods that have been or goods that have been sold. Again, there's nothing legal there in terms of the goods coming back to you, but maybe your past practice is that you will take those goods back regardless of whether or not that there is a receipt with the goods that you bring back. So you are looking there at a demonstrable pattern of past practice, so you would have to go through there and provide for the potential returns that you've got from the sales that you've made. Okay, so they're just a couple of examples of your constructive obligation. Okay. Then what you've got there is a probable transfer of economic benefit. So again, going back there to the framework, and a probable transfer of economic benefit here is that we're looking at there being a greater than 50% chance of that outflow occurring. Okay, we don't have to specifically measure it in reality. We just need to get a feel of what the likelihood is. If it's highly likely, okay, so more likely than not, then it is probable, and that is deemed that there is a greater than 50% chance per the standard. Okay. We then also need to be able to go through there and measure the outcome reliably, because at the end of the day, we're processing a debit and a credit within the financial statement, and if we don't know what the value is, then we can't just guess at a debit and a credit value. Okay. It might not be that we are able to measure it reliably at the reporting date, but maybe in the subsequent events that happen just after the reporting date, which we'll see in the next chapter in IAS 10, maybe that might give us that reliable measurement, and therefore we will be able to make that provision at the reporting dates. Okay, but key bit that you've got there is that you need to be able to have a present obligation as a result of a past event that gives rise to a probable outflow of economic benefit that you can then measure reliably. Okay, and effectively all that just goes back, doesn't it, to the framework, but then you've got some bells and whistles that are added on in terms of the type of obligation, measuring the probability, and like we'll see now, a little bit more in terms of the measurements. Okay, so remember what we have to think about when we're looking at recording transactions. We need to look at the initial measurements and then subsequent measurements. So here, if you're reliably estimating the outflow that is likely to occur, is the best estimate of the expenditure. Okay, so what you've got to be careful of there is the best estimate of the expenditure and then the expected values. Okay, because with the best estimate of expenditure, you go with the most likely outcome. So if you are probably going to lose a court case, you will provide for the most likely outcome of a variety of different outcomes. So the settlement might range between 3 different values. Each one has a different probability. You will go with the one that has the highest probability. Okay. Expected values is just whereby maybe we have several different possible outcomes, all of which are going to happen. Okay, with the legal case, there's different outcomes, but only one of them will happen. So you go with the most likely. But when it comes to warranties, warranties are a common area whereby we look at expected values, because we know how much it will cost to make, say, major repairs. We know how much it will cost in terms of minor repairs, but that will be the total cost for major, the total cost for minor, assuming that all require major or all require minor. So what we need to go through and do there is work out an average, okay, an expected value based upon the percentage that we think will need major repairs and the percentage that will need minor repairs. Okay, little tricky one. Have a go at some of the questions that you've got within your study text, and that will go through there and help you along there. Other ones as well that you've got there, you need to discount to present value if materially different. Okay, so your prime example that you have there ties into property, plant and equipment, whereby maybe we have to go through that and look at the dismantling cost. So remember that, is it with the dismantling cost? What happens there is that you go through and you have a legal obligation. So with the dismantling cost, we will go through that and credit the provision. But then, because it is directly attributable to the cost of the asset, you will debit your PPE. So you will add that to the cost of the asset, but be careful, that is recorded at the present value. So you look at the future value, multiply it by a discount factor to get yourself the present value. Okay. What you've then got in terms of your dismantling cost is the subsequent treatment. The subsequent treatment is referred to as the unwinding of the discount. So effectively increasing the value of the provision up to the amount that will be settled when we come to dismantle the PPE. Now you've got to be careful there, because yes, we are going to go through and credit the provision. So we will be going through that and increasing the provision using the percentage that we've initially done the discounting at. So if it was 10%, you apply 10% to the outstanding provision each year. The key bit that you've got, however, and this is where students make the mistake, do not debit PPE. You will debit your finance costs, and that will be there within the statement of profit or loss. Okay, so you credit the provision on the SFP, so increase it each year by the percentage, and then the other side of the entry is a finance cost. It does not go to property, plant and equipment. When you've initially gone through there and recorded the debit to PPE, that's capitalized and then depreciated, and then you don't touch the PPE at all with anything else to do with that provision. Okay, you leave it as it is. Okay, and then in subsequent years you will unwind that discount. Okay, there we go. So just be aware of that. So there's some little tricks of the trade there in terms of the best estimate of the expenditure with regards to a legal case, the expected values when it comes to looking at a warranty, and then discounting things back to present value, commonly seen with regards to PPE and dismantling costs. Okay. Subsequent treatment, obviously you need to check that provision every single year. It could be settled in the year, in which case it's gone. But if it's still outstanding, you just need to go through there and check that it hasn't changed materially in value. And also, if you have several different provisions, you can only use that provision for the specific purpose that it was originally created for. Okay, there we go. So that's your provisions. Okay, whereby you record the provision in the financial statements. What happens, however, if some of the criteria fall down? What happens if it is not a probable transfer of economic benefit? What if you cannot measure it reliably? Okay, what if you're not sure about the obligation? Okay, well, what you may have there is a contingent liability. Okay, a contingent liability arises when there is a possible obligation. So You know, you're not too sure if you've done anything wrong, okay, or you're not too sure if you're going to have to go through and repay for any warranty claims that are made. Unlikely. This tends to be more regards to legal cases, and there's a possible obligation, not a probable obligation. But it could be that maybe there is an obligation that you have broken the law, okay, determined by the court case. But maybe you cannot measure it reliably, which is pretty rare. But maybe there is only a possible transfer. So maybe you've got some whiz as a solicitor who's managed to wangle you out of it. Okay, it looks like you've broken the law. Okay, so there's a possible obligation, but there's only a possible transfer as well. Okay, and if there's a possible transfer, effectively what we're saying there is that there is less than a 50% chance of you actually losing the case. Okay, so what have we got? Let's have a look at some questions. First example that you've got, typical multiple choice style question, wants us to work out what the correct action is to be taken for these two items. So you've either got the create a provision, you will disclose by a note. So bear in mind that if you have a contingent liability, what you will go through and do there is that you will disclose it within the notes of the accounts. Again, my computer just nearly fell on the floor. Too much excitement going on within the room. So you don't recognize it. It's not recognized, it's just disclosed. So here, you're either going to create a provision, disclose a contingent liability, and if it's such a remote situation, then you just do nothing. Okay, don't bring it to the attention of the shareholders. So what have we got? It says the following items need to be considered when we're looking at the financial statements. So the first one there says that the company gives warranties. And statistics show that 5% give rise to a warranty claim. Okay, so are we going to make a provision? Do we have a present obligation as a result of a past event? Is there a probable outflow of economic benefit, and can we measure it reliably? Okay, well, the answer is yes to all three, because a warranty is a legal obligation. You've sold the goods with the warranty to fix it or to substitute it for a new product. Okay, so that's the obligation. Is it probable? Well, it's happened in the past. You know, 5% of claims arise, so therefore, yeah, it might only be 5% of the total, but that's still probably going to happen, isn't it? Okay, so therefore we meet the second criterion. Can we measure it reliably? Well, yes. You know, we know how much we have to spend in the past. We can therefore use that as an estimate to reliably measure what we spend in the future. Okay, so for the first item, we are going to create a provision. Second one says the company has guaranteed the overdraft of another company. So maybe you're the parents and you've got a subsidiary, and you being the parents have promised to pay that overdraft if the subsidiary cannot do so. So again, we're accounting for uncertainty. We're not sure whether we will or we won't have to make the payments. Okay. However, it says here the likelihood of a liability arising under the guarantee is assessed as possible. So if it was probable, there is a legal obligation because we've signed the guarantee. It would be probable, so therefore it would be more likely than not, and we'd be able to measure it reliably because we know the amount of the overdraft. Okay, if that was the case, then we would make a provision. However, it's only possible, so it's not likely that we're going to have to pay it, but there is some small chance that it might happen. So if that's the case, it's going to be there via a disclosure, as that will be a contingent liability. So in the first one, we are going to make a provision, and in the second, we have a contingent liability. Okay. There we go. So that's the question. What's the answer? What have we got? Which ones have we ticked both for? A. Okay. Create a provision and disclose by a note only. Okay. So answer A. Read the question carefully because that should be one that you are looking to get correct. Okay. Next one. What have we got? What is the nature of Justina's liability? And how should it be treated in the financial statements for the year end August 2009? Okay. So there's a bit of uncertainty. So we're going to provide for it, disclose a contingent liability, or do nothing whatsoever. So it says Justina supplies fish to a local restaurant. In August, the month that we're looking at, she supplied the restaurant with some shellfish and has now heard that some of the restaurant's customers have suffered attacks of food poisoning. Nasty. Okay. Shellfish. Dangerous. Yeah, steer clear. The restaurant has claimed that this is because of Justina's shellfish. Told you, steer clear. And has commenced legal action. Okay, so that legal action that has been commenced in August 2009, do we have an obligation? Are we obliged to go through there and make a payment to the restaurant? Okay. Well, it says a local solicitor who specialises in food poisoning cases. These solicitors make money out of all sorts, don't they? But there we go. Imagine being a food poisoning specialist. I suppose a lot of it goes on, doesn't it? Okay. This food poisoning specialist solicitor has advised Justina that she has a 42% chance of losing the case. Okay. So is that greater than 50%? No. So therefore, it is only possible. It is not probable. Okay. So it's possible we'll have to pay 300,000. So yes, we know the amount. Okay. There is a legal obligation, but we're not sure that it will be probable. It's more likely that it is only possible. So if that is the case, then what we're going to have to do is within the notes to the accounts, we will disclose a contingent liability. Okay. In terms of the disclosure, what do we disclose? Effectively, we just go through there and disclose the nature of the event, and then we will disclose as well the numbers, the potential financial impact. Okay, and then that will incorporate the likelihood of us having to pay that. So there is only a 42% chance, which is only possible. Okay. If that percentage decreased further and it got 5-10%, then that would be remote, and therefore we wouldn't be too worried about it. Okay, that's not even possible. That's so remote that we would do nothing at all. No recording of a provision, no disclosure, and nothing else at all. Okay, so there we go. That's just a couple of examples about provisions and contingencies. In the next video, what we'll do is we'll just advance it a little bit further by beginning to look at specific scenarios that the standard notes with regards to provisions. So I'll see you all shortly.